Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Steve Rawls, Senior Portfolio Manager at Trivest Wealth Counsel with Wellington Altus, will be joining us for the hour. In 30 minutes, we'll focus more on the upcoming Bank of Canada rate decision and the latest inflation data south of the border. We'll be joined by Eric Lascelles, Chief Economist at RBC Global Asset Management. And of course, we want to hear from you on First Call. Reach out with your questions on global large caps, and we'll have Steve answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. You can also email us, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The Bank of Canada will announce its latest decision on interest rates later this morning. The BOC widely expected to leave the key rate unchanged, 2.5%, which would be the fifth straight hold. Now, reasons to stay there include conflicting economic signals, along with ongoing uncertainty over the Iran war and U.S. trade. Apotex has raised $1.3 billion in its initial public offering. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 a share. The listing comes nearly a decade after the murder of the company founder, Barry Sherman, and his wife, Honey, has not been solved. The company was sold in 2023 to New York-based SK Capital Partners. The head of Cenovus is calling a plan for a massive carbon capture project uneconomical. The Pathways carbon capture project is considered a central condition for new oil infrastructure, but in a speech yesterday in Calgary, Cenovus CEO John McKenzie said the plan doesn't address how the industry would ship an extra 1 million barrels of oil a day while also spending capital on the Pathways project, which he said would cost as much as $30 billion. Now back to our top line story. The Bank of Canada widely expected to hold rates later today, but the backdrop is getting more complicated. Growth is slowing, inflation picking up. Markets are starting to rethink what comes next. And then there's Iran. Let's bring in our guest for the hour, Steve Rawls, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. Steve, thanks as always for joining us, sir.
Great to be here, Roger. How are you?
I am good. An interesting day. The banks have already got a complicated decision to make, and it's just getting more complicated, isn't it?
It is indeed. It sort of states how the world is for 2026 here. There's a lot going on. But today, I don't think there'll be a big news day with the Bank of Canada. Expectations are for a pause. But let's take a look at some of the comments that come post the decision today. So it's... I think overall that looking at the market, they're in a bit of a bind because either we have low growth or no growth. Let's not get in that debate. But obviously, the economy is not really flying on all cylinders. No, that's the bottom line, and that needs to be accepted and move away from the politics on that. But at the same time, we have a very sticky inflation, and what's happened over the past hour with the Iran situation is not helping the energy costs as well.
So what is the key? I mean, obviously they're all important. Is there one that the bank can even focus on and say this is what's going to drive it?
Yeah, the growth versus inflation is what it's coming down to. I think right now, though, I think inflation is the key. I think that it's the main mandate for the bank is to make sure that we have stable prices. So I'm looking at it from a view of the curve is probably going to do some flattening here. I think that the inflation side is really going to be apparent on the short-term part of the yield curve, and the growth sector will really focus on the longer term. So I think we'll see a bit of a flattening of the yield curve after going forward here. So today it's going to be a neutral day, but overall I look at this as a pause, but it's not a confident pause. This is more of a situation where it's a constrained pause. At the end of the day, the Bank of Canada is quite stuck in what it can do, so it's not going to do anything today.
I don't blame them. I'd probably go hide under a rock. I'd go hide under a rock if I could right now, trying to resolve all this. I mean, look, we got to throw in Kuzma as well. That's coming up in the negotiations. That pressure is there as well.
Yeah, it's coming down to 3 weeks away, and nobody really knows what's happening there. There's not a lot of engagement, obviously, and the Trump administration has a lot on their plate right now. They are having good talks with Mexico. So my concern is that there could be a bilateral agreement with Mexico, and Canada might not be part of that conversation. So once again, just like the Bank of Canada, our federal government's stuck as well. We're waiting for an outcome here. We can push and we can talk as much as we want internally, but until we're sitting down at a table with the U.S., these concerns continue to mount here. And
what's happening in Iran right now, or in the Strait? It's looking like it's flaring up again. I mean, I could say that now, and in a half an hour, I could be proven wrong again. What kind of a factor is that then, too, with oil?
It's a major factor. I mean, we saw it in the inflation print last month, so expect that to continue. We're worried about the Straits of Hormuz, but we're also worried about the Red Sea issues as well. So this situation that a ceasefire is going to come any day, it's something that I really haven't looked positively on. The Iranian situation is the negotiations that are on the table right now. I don't see Iran agreeing to that at some time. They really are at a state where they got nothing to lose. If they back off now, they're really are vulnerable to an overthrow of the government. So I don't see that really happening. And the U.S. side, it's going to be very difficult for the U.S. to walk away from this in a victory. So I'm quite concerned. And overall, the inflation numbers are really dependent on the oil, and the inventories are at drastic levels right now. And we saw comments from yesterday by the EAI yesterday about the lowest inventories levels in oil. And hasn't really come into play with the markets, with oil hovering at $90. I expect it to get over 100 over the near term here.
All right, let's jump ahead to September, and we're going to bring out the crystal ball. Iran's still simmering, the straits maybe not open, and we're still working on a deal with the U.S. The economy's still struggling. What does the bank do then?
If that's the situation, then the bank is really in a tough bind because if we have 4% inflation in Canada, they're going to have to increase. But at the same time, if we have growth concerns, it's a stagflation is something that the Bank of Canada really has to deal with. But I think the number one priority is inflation. But at the same time, in Canada, we have the extra influence of the mortgage renewals that need to be done as well. So everybody who got a mortgage in post-COVID at 1.9% now has to get it over 5%. Well, that's going to have a major impact on the consumer. So overall, I don't see the Bank of Canada making a move here over the next couple months until there's some resolution here. So it's data dependent, but they got to watch the dependent. I don't see them making a move, and that's why it's really a constrained pause. It's not a deliberate pause.
All right, we got to take a break on that note there, Steve, but I know you're sticking around for the hour. Thank you as always. And up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets of what could be a volatile day. We'll start with U.S. futures. And where do they stand right now? Yeah, they're all off right now. You can see the NASDAQ down well below 29,000, off by 1.5 points. Concern over what's unfolding in the Middle East, and the tech sell-off continuing today. The S&P 500 also off. Looking in Asia, you can see they all took a hit today. Same pressures. Nikkei down by 1.89%. Hang Seng by 0.64, and the CSI 300 off by 1.1. In Europe, lots of red there as well. The FTSE off by 0.46. The CAC 40 about the same, and the DAX off by 0.9%. All of this being driven by concerns about what's unfolding in the Middle East and the tech sell-off. Now, TSX off by 0.19% yesterday. It had a down day, but managed to rally back. It was off a little more, but dragged down by energy and materials. Some of the winners and losers from the TSX. TerraVest Industries up 6%. Gildan Activewear up by 3.86. Energy Fuels off by 5.7. And 5N Plus off by nearly 10%. And taking a look at the metals right now, look at gold. It's pushing down towards 4,100, off by nearly 3%. Silver off by 2.4% roughly, down below $64. And copper's off by 1.38 at 623. Oil yesterday dropped. Western Canadian Select off by a little more than 3%, almost $74 a barrel even today. Let's see what it's doing now. It's up slightly, still below 90, but up WTI by 1.8%. The U.S. is pulling ahead on an AI-driven growth story, but that same investment surge could mean inflation stays stickier and rates stay higher. Let's bring back Steve Rolls, Senior Portfolio Manager at TriVest Wealth Counsel, Wellington Altus Private Counsel. Steve, that inflation thing is just one of those things that doesn't want to go away right now, does it, on both sides of the border?
It's been a while, hasn't it? It's been a couple of years, and it's really coming through right now. And what's unique about the situation now is that throughout the past 100 years, the U.S. economy has really been a U.S.-driven consumer economy, where right now with the AI CapEx spending, it's more of an investment type of economy. So it's not as volatile and to interest rate hikes. So we're seeing a bit of a conflict in the market where there's sort of two sort of stories, where we have a growth story with the AI and we have an inflation story, which is the real economy. So it's very tricky for many investors right now.
And how are you treating it then? What are you looking at? What are you watching for with all these things that are going on right now?
Well, most of the time, most people in the market play one side or the other. They play the growth side with what's new in the future, what's going to happen, or they play the real economy about what's actually happening, more of the bricks and mortar type of economy. And the way that we're positioning our portfolios is that it's best to play the market in a way of as much diversification as possible by having a bit of both. Ensure that you're having some of the growth side with the AI, because it is fundamental, it is structural. This is not a .com type of situation. The AI uptick is really coming into play. 50% of participants in the market are using AI. So it's a situation where that's in 3 years, where .com when the web came out, only 17% of the consumers were using the web at that time. So it's fundamental, it's coming. But how to invest in it is really to be prudent and to make sure you're investing in strong quality companies that are already producing strong quality cash flows. Don't buy the next new thing, buy the companies that are proven already to be in that space.
I've been there and done that, so to speak. You still think we're in the build phase? I've heard some people start talking about maybe getting into the benefit phase. How close are we where it really becomes full-blown that this is now part of the structure? It's part of the infrastructure. It's part of people's everyday lives, businesses' everyday lives.
Yeah, we're starting to see the monetization of it now. So last earnings, we saw Google report and we saw Meta report that they're starting, and Microsoft as well. They're starting to see some monetization of some positive growth out of their spending. So while these numbers are huge on the CapEx side, and we're waiting for the money to come in, and what's been happening is that the inflation has really been a big component of the outcome of this. But at the same time, in the long term, AI will benefit and should be a deflationary aspect of the economy. So I think it should start to see more and more momentum on the AI adoption and look for more monetization here. So it's quite a positive outlook right now.
And are we starting to see the support behind it, the things that are needed coming back home and being built here? Is that happening?
Yeah, that's how we're positioning our portfolios, is that there's sort of two buckets. You got the bucket of the growth, which I just spoke about with the semiconductors, foundries, and the data center building. But then there's the second bucket, which is more of the Canadian bucket, more of the old economy type of stocks, where it's the energy demand. So we need energy, we need oil, we need pipelines, and we need utilities. So by having a combination of both, I think you're able to have more diversification and protect your portfolio from the inflationary impacts as well as a real economy. So it's we've gone through the past 20 years of really more of a passive type of investing, but right now active management is a key component to having successful returns.
All right, and then Canada and Europe, are we playing catch up? Will we catch up?
Yeah, we're really lagging behind, and it's not really part of our culture to really be part of the AI growth story or technology growth. Some would say we've missed that boat for the past 30 years, and we're still an economy that's based upon commodities. So it's going to, I don't see us catching up. It's a situation where we can leverage off some of the growth in the US. Some of our greatest commodity companies are leveraging off the growth of the US. So while that demand is in the US, there's still good, strong Canadian companies. So buy Canada to ensure that you're getting part of the US growth.
It is interesting, though, with especially with AI and quantum computing, when it comes to the cutting edge, we're up there, and then we seem to watch it go down to the States, don't we?
We do, and it's been a situation for 40 years here. I think John Kretschenk, we talked about the brain drain back then. That was part of my generation, and we've seen it. We have incredible education in Canada, and we have incredible talent in Canada. We have incredible startups in Canada, but what we lack in Canada is a proper functioning capital markets for smaller companies that get to the next stage. When a good, strong Canadian company comes into play, it tends to go down south and gets gobbled up pretty quickly. And it's just, we've seen it happen many, many years. I think Shopify is sort of a poster child for a new type of Canadian company, but it's just part of the culture of Canada. We need to have more defined capital markets, and that comes to really more and more deregulations to ensure that we have a more competitive base here.
All right, we got to take a break on that note, Steve, but we'll be back to see why Alphabet is on your radar. That's coming up. All right, time to see what's on the radar for Steve Rolls, Senior Portfolio Manager at TriVest Wealth Counsel, Wellington Altus Private Counsel. And Steve, Alphabet is pinging for you. What's up there?
It's been one of my best performers in my portfolio for the past year, and it's come off a little bit over the past month with the overall movement for some of these AI stocks. I think it's a good buying opportunity. It's really flying on all cylinders from a construction point of view. Their cloud growth is up over 60%, and they reported last quarter, and the backlog for their cloud technology is over $460 billion. So while they're spending money like it's no tomorrow, they with their incredible cash flow that they have, and last week they announced $85 billion of an equity launch, which is actually more than SpaceX is looking for. So that's kind of the numbers that we're looking for. But with their backlog and their AI really flying on all cylinders, with Gemini really pushing forward as well, it's a situation where the AI race is not just for who's promoting and getting the most intelligence. It's really who's offering the most compute. And it's a race for compute technology and the infrastructure. And Google's leading the way for that. And I expect that to continue. So while they're ramping up and spending a lot of money, I do expect monetization to be the flavor for Google for the next few years here.
Any concerns about with that compute being a shortage? We had a guest on yesterday talking about that there might not be enough ability for compute.
Yeah, but that's definitely the situation. But it is overall a good problem. Google's situation where they're actually competing with the NVIDIAs of the world with their own TPU chips. So while there is a confluence of some headwinds with potential data center builds and energy, there are ways for these companies to get more involved and to help with that energy themselves. These companies are as big as some governments, and they're able to ensure that there is enough infrastructure to allow for not just the making of the chips, but as well for the energy. So while there could be some short-term situations here, I'm quite confident over the next 5 years that there will be some resolution on that demand.
Is there anything you'd like to see them do that maybe they're not doing right now? Being inside at Alphabet and knowing what's happening, but are there some things that maybe you have a little bit of a concern about?
Yeah, there's always some concerns. I think what I'm really interested in seeing, last quarter they announced about $40 or $38 billion of a paper profit with some of their private equity deals, specifically likely Anthropic. They don't go into the details, but they have invested a lot of Anthropic. So I think that while they're playing the infrastructure side, they're also playing the intelligence side by hedging their bets. So I think it would just be, what would be great for Alphabet would be to have a little bit more clarity on where they're going forward on the development of the intelligence side as well. So okay. It's really combining their YouTubes and their Googles and to sort of get a clarity as to what their direction they're going to take for the AI boom that's coming.
All right, let's jump to something that's not AI, Nutrien.
Yeah, it's on the other side of where we're looking at. And so we're looking at fertilizer for food and whatnot. And the stock has come off a little bit here. And the Straits of Hormuz was a situation that sort of brought it to light over the past couple months here. But it's still a high quality company. It's in a bit of a cyclical early recovery. So fundamentals are improving. And I'm quite optimistic because we're seeing some tight supply here. So I'm continuing to hold Nutrien. I think that it's looking to be a good buy opportunity as it has come off a little bit here.
All right, I want to get one more in here. BAE Systems.
Yes, weapons. We're talking about NATO and their spending. It has come off quite a bit. And anytime we hear about ceasefires, the stock tends to come off a little bit, which I think is somewhat overdone. So I think it's a good buying opportunity right now because all NATO companies, including even Canada, plan to spend more money on defense. So while the U.S. is really spending money, the rest of the Germanys and the rest of Europe will continue to expand here. So I think BAE is an incredible company that looks to be a good opportunity right now with some of the peace talks that have gone on for the past few weeks here, but obviously aren't there yet. So I think it comes to the play that defense is a good sector to be in right now.
Yeah, and defense has kind of floated along with everything that everybody got excited about it, and then it seems like it's kind of calmed down. We don't really talk as much about what's unfolding in the defense sector.
Yeah, it is. The market tends to be showing some of this. It gets tired of some topics, and it does tend to like push away a little bit. But at the end of the day, BAE and other defense companies have big backlogs, so their earnings certainty. And when you have earnings certainty, it's a very strong tailwind behind each company. So I think that the defense sector, people don't really want to talk about it too much. About how much they're spending on defense when we have all the other social issues, but it is mandatory that we have more and more defense spending here.
All right, we got to wrap it up there, Steve, but lots more to talk about. Still ahead coming up, we're getting the latest U.S. inflation numbers and previewing the next Bank of Canada rate decision with our next guest. And our phone lines will open soon for our first call segment, 1-855-326-6266. Email firstcall@bellmedia.ca. We are just getting the latest inflation print from south of the border. To break down the numbers, let's bring in Eric Lascelles, Chief Economist at RBC Global Asset Management. Some of the numbers I'm sure you're looking up as well. Eric, thanks as always for joining us. CPI month over month, survey was a half point. Half point is what we got. Core CPI, the analysts were saying 0.3, 0.2 is what we got. Year over year, 4.2, and that's what everybody was expecting. And core CPI year over year, 2.9. So I guess no real surprises from the numbers that we're seeing. Any surprises elsewhere?
Not huge ones. And so thanks so much for having me. We're continuing clearly to see some heat in the headline numbers from the war with Iran. And so this is a third straight month in which there's a lot of pressure that we can see there. Core numbers not quite as high. There is a bit of a statistical quirk where we had some artificial housing heat the prior month, and it's come out of the system a little bit. I think that helped to settle core inflation a little bit. But the broad story is one in which there is still clearly some pressure here. The year-over-year numbers rose, so this is now a 4.2% year-over-year print for headline CPI. That's probably as bad as it gets. So, of course, that is predicated on not having a further surge in energy prices and hopefully some sort of resolution to this war over the next month. But as it stands right now, this is real heat, and obviously that does perhaps complicate the life a little bit of the Fed, but it's not particularly surprising just in the context of the sort of hints we were getting leading up to this release.
All right, Steve, you want to jump in?
Yeah, just any specifics that are pointing out besides the energy, specifically shelter, and how it's impacting overall consumers?
Yeah, no, it's a great question. And so, I guess the big question mark that economists are asking is the extent to which the energy inflation broadens out to some extent into other items. And so, as we look at that, I would say that, food inflation is continuing to run relatively hot. On a year-over-year basis, it's now cooking along at more than 3% year-over-year. And so that is a source of pressure. Beyond that, the service side has tended to be a little bit less problematic. Obviously, transportation costs don't feature quite as centrally. Shelter inflation, as I mentioned, sort of in the mix there, but not particularly moving here. And ultimately, looking at some of the airline fare data, and I'm just getting this in the corner of my eye, possibly a bit of heat there, but I'll have to circle around in a moment. And so, I guess one in which really it is still all about Iran right now, and so that's the issue. And the question mark is, listen, you can have energy prices move for 3 or so months, and it can be relatively contained in terms of not spreading too broadly beyond the energy space. Classically, just in terms of past energy shocks, once you're through 3 months, and so we are now at that point, that's when you do tend to see it start to pick up and bleed through. And so perhaps we're getting a little bit of that on the food side, and it gets a little harder to put the genie back in the bottle. And that's when central banks, and of course we've seen Fed pricing shift higher over the span of even the last few days. That's when you do need to start to wonder whether the Fed might be more of a hiking mindset than a cutting mindset at some point this year.
And with the oil prices, also I think the other big thing is the reserves are now getting drawn down. Could that add to that pressure if there's no resolution? Could we see it spike even higher?
Yeah, I mean, so that's a great point because, if this war continues, it's not just that oil and natural gas prices stay high. In theory, they should be rising and rising and rising as inventory levels are depleted and the ability for demand destruction to work just diminishes. And so that's the danger. And so, I think we'd all perhaps assume this war be resolved by now. Clearly, it hasn't been. It's still tempting to think that it might be in the context of peace treaty negotiations and so on, as much as the last 24 hours haven't been especially promising. And so, if this can get wrapped up significantly in the Strait of Hormuz reopened, I would say over the next month, then I don't think we need to worry too much about persistently higher inflation that sticks around and the sort of scarring you'd see associated with that. If it keeps going and we're checking in 2 months from now and this is still a shortage of energy, that's where this starts to show up more fully in goods inflation, and central banks probably need to leap to the ready a little bit more. So they have a bit more time here, but the longer this extends, and here we are 3 months into hot inflation, the harder that job gets.
And I want to bring it back just for a sec. Just bring it back to the Bank of Canada. We were talking about it earlier. What do you expect from them?
That's right. So the Bank of Canada is today, and so doesn't have the luxury of waiting a few more weeks like the Fed has. And so, the main outcome is not particularly in question. It seems pretty clear, barring an enormous surprise. This is an unchanged overnight rate, and so 2.25% likely to prevail. It's been very clearly a wait and see mode. The data since the last go round has been quite mixed, and so not clearly pushing one way or the other. On the economic growth side, of course, you had famously that second consecutive quarter of GDP decline, and we can quibble over whether it was a recession or not, and 2 of the 3 GDP estimates were up, but the point is it was soft. Conversely, of course, we just got that big Canadian job number on Friday, 88,000 jobs, and so you're getting sort of wildly contradictory information here, and it's hard to know exactly what to do with it, but it probably isn't an argument for making a big, bold, difficult to reverse sort of step. The inflation side, obviously Canada has also seen some extra inflation here from this energy shock, not as much as feared though, and so Canada's sitting, without new numbers today, I should admit, but sitting at a 2.8% headline print. The U.S. is now north of 4%, and so we'll still need to get our May number, but the point is it's been much better behaved, and the core numbers are in the realm of 2%. And so I think the Bank of Canada is probably right to remain on hold here. They've spoken to the possibility of needing to hike at some point in time, particularly if the energy shock isn't resolved. So a lot does come back around to that. But I think the Bank of Canada can be pretty comfortable at this point and really looking for things like, does this war continue? Really, does the Strait of Hormuz remain closed? Does the energy price inflation bleed into other areas? We're getting bits of that in the U.S. Let's see if that happens in Canada. For that matter, will tariff uncertainty be resolved? Our bet would be not for a while, but that would certainly be welcome if it was. And does CapEx pick up? There have been some government inducements to spend more. That's been a missing piece of the puzzle for Canada. And so for now, I think on hold, we think hikes later, probably, but maybe not a lot of urgency based on the conflicting data right now.
All right. Steve, last question to you.
Yeah, just a quick question. With next week, we're going to hear from Kevin Warsh being the new Fed chair, and decision coming up next week. And there's a lot of discussion about inflation and the numbers and the accuracy and whether or not it can be improved. Do you expect to see any changes coming from our first Gen X Fed chair?
Right. Yeah. Good point on the generational comment. We'll have to see exactly what that means. And so, yeah, new Fed chair. And gosh, I mean, I think he'd like to be dovish if the conditions were to permit it. And, interestingly, not a big fan of printing money. So you could say maybe a steeper yield curve would be sort of a logical, loose approximation of what his term might look like. As it stands right now, I'm not assuming big radical changes. And of course, he doesn't get to control the economic statistical data or how it's evaluated. So I would assume CPI sort of continues to run as we've seen in the past. I suspect he will be focusing significantly on technology. And so if AI is advancing as quickly as it seems and proves to be deflationary, that is possibly a good excuse not to have to raise rates. But at this point, I think it's probably a heavier burden to carry to try and make any kind of rate cutting argument when we're seeing the high inflation and, it should be said, quite a resilient U.S. economy as well.
All right, we have to wrap it up there, Eric. But thanks as always for joining us. Appreciate your insight.
Thank you.
Eric Losell. The Bank of Canada will announce its latest decision on interest rates later this morning. The BOC widely expected to leave the key rate unchanged at 2.5%, which will be the fifth straight hold. Reasons to stay on hold include some conflicting economic signals as well as ongoing uncertainty around the war in Iran and U.S. trade. Apotex has raised $1.3 billion in its IPO. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 a share. The listing comes nearly a decade after the murders of the Apotex founder Barry Sherman and his wife Honey. The company was sold in 2023 to New York-based SK Capital Partners. The head of Cenovus is calling a plan for a massive carbon capture project uneconomical. The Pathways carbon capture project is considered a central condition for new oil infrastructure, but in a speech yesterday in Calgary, CEO John McKenzie said the plan doesn't address how the industry would ship an extra 1 million barrels of oil a day, while also spending capital on the Pathways project, which he said could cost as much as $30 billion. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Steve Rawls taking your questions on global large cap stocks. Reach out 1-855-326-6266. You can email us as well. First call at bellmedia.ca. For a look at some early market movers, we are joined now by Bloomberg's Divya Balji, managing editor for breaking news in the Americas. Good morning, Divya. Thanks as always for joining us.
Good morning.
All right, Supermicro, fun to say. I think of them as a little like Hot Wheels cars kind of things, but it's not, and it's not having a good day.
No, I mean, this is a very volatile stock to begin with. Any sort of news that comes out from this company, it tends to move in one big direction or another. So now they've announced that they're looking to raise about $7 billion through some sort of equity raise or equity-linked transactions is what they're referring to it as. In this case, they're going to use that money to fund purchases of components that they need to meet this demand that they have, or these orders that they have, $35 billion worth of orders for AI servers. So taking that money and putting it into this demand that they have when it's directly linked to AI is basically where they're going to use this money. And that's obviously, every time you look at selling shares, a company does that or talks about it, the stock just tends to drop. One thing I would say about this is, one analyst in particular was pointing out how, yes, this could impact the near-term EPS of the company. Dilution is obviously a concern anytime these types of things happen. However, this analyst is also talking about how that is some serious demand that they're getting for AI servers, $39 billion. And in 2027, perhaps that could actually have a big impact on their revenue, which could go above and beyond the $50 billion estimate that average estimate that analysts have at this point. So if you were to look at it in the long term, is this capital raise possibly going to help the company get to a much better place? That's possible. But at least for right now, the market is quite focused on that sell-off and that equity raise that they're looking at.
All right, we'll see if the short-term pain pays off. Cracker Barrel, iconic American brand name. What's going on there?
Yeah, have you ever been to a Cracker Barrel? I haven't myself.
I was just thinking about it when I was looking at your notes, and I was like, I may have stopped there once on the way to Florida in 1981. I may have. I can't remember.
All right.
I was 4 at the time. I'm lying.
So clearly, clearly a chain that's been around for a very long time. And if you remember last year, they had this massive backlash, about their logo. They tried to modernize it. All their customers were quite unhappy about it. They had to change it back. Right now, they actually had some really great numbers. They've boosted their revenue forecast. That's actually giving it a bit of a boost to the stock itself. The reason for that boost mostly is because of this Americana merchandise that they're actually selling. I think they're calling it American Heritage. And a lot of it has to do with their salt and pepper shakers that they're selling, T-shirts, all these different kinds of things. And the CEO is specifically pointing to that as the reason for great numbers right now. And he's saying it's selling so fast that's really why, the numbers are so great. So good news for Cracker Barrel after probably what must have been a little bit of a harsh year for them when it comes to their customers. I personally would love to go take a look at what they're selling. I may not buy anything, but I would love to go see what they're selling and why people are so interested in it.
Okay, I'm on their website right now, and one of these salt and pepper shakers you could buy is shaped like a mini drill. Like literally, like
cute,
an electric drill. Yep. Whatever sells, God bless it. All right, Divya, thanks as always. Bloomberg's Divya Apology. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including new coverage for Hemlo Mining. Time to take a look at some of the notable analyst calls and recommendations. We'll start with Canaccord Genuity, initiating coverage of Hemlo Mining, a recommendation of buy, PT set to $11 Canadian, implying a 78% increase from last price. Raymond James analyst Timothy Thain raising the target on United Rentals to $1,275 from $1,100, maintaining the outperform rating. The new PT implies a 17% increase from last price. And Oppenheimer lowered the firm's price target on A.O. Smith to $75 from $80, keeps an outperform rating on the shares, although growth is likely to remain challenged over the near term. Oppenheimer believes A.O. Smith's replacement-weighted revenue, cost initiatives, and balance sheet portfolio optionality remain supportive of stronger growth and profitability looking forward. Well, Ontario's premier is on a charm offensive in Washington in advance of CUSMA trade talks during his trip to the U.S. Doug Ford said the Americans rolled out the red carpet. CTV's Abigail Beeman has more.
What's the pitch? Well, the pitch is building Fortress North America.
Ontario Premier Doug Ford takes to American airwaves again.
What is Fortress North America?
Well, Fortress North America is about encouraging people to invest more in both countries.
Selling not just his province, but his new plan that highlights the benefits of the Free Trade Pact ahead of the July 1st deadline. Echoing Canada-U.S. Trade Minister Dominic LeBlanc, Ford says he's optimistic about a deal, and he downplayed a cancelled reception with American billionaire Ross Perot Jr.
We have been jammed, meeting everyone down here. They rolled out the red carpet for us. They treat us so well.
A ban on American booze is a major irritant for the Trump administration. Ford said he'll back off if there's a trade deal.
I just want to get this deal done, and then we'll put that booze back on the shelves, and we welcome everyone. Maybe we'll have a little drink of Kentucky bourbon or something in Ontario.
But the premier has also been a lightning rod.
America's jobs and growth are at stake.
With the U.S. president calling off trade talks after this Ontario ad, Ford said he had a positive chat with LeBlanc ahead of his trip. Other ministers displayed a united front.
You know, it's always good to have Team Canada talking about the benefit of the relationship.
Tariffs are really, really hurting a lot of Ontarians and a lot of Canadians. And I think it's important that we talk to American leaders across the U.S. I'll be going to the U.S. this summer. There will be many of us that will be going.
Premier Ford has taken a very positive approach, almost conciliatory, compared to other statements that we've seen in the past. So pour a little sugar on it.
Ford said he was meeting 4 American lawmakers today, but no one from the Trump administration. He's leaving that up to the feds. LeBlanc has said he'll be speaking with his U.S. counterpart this week.
That was CTV's Abigail Beeman. When we come back, Steve Rolls takes your questions on First Call. Time for First Call and first email, and that belongs to Len. What is your outlook for Allied Properties REIT over the next few years, or other similar REITs? Seems like fresh money is moving into the sector as the tech sector sells off. Steve.
They're doing some good things in the way that they're restructuring their balance sheet, but their stock is way down because of their overall leverage and their balance sheet. So it's going to take more time for this to really come into play here. So I tend to stay away from the REITs and the property sector. I think it's trying to get the rebound for the office recovery on the urban side. It's just too difficult. So while the high yield and is very attractive, but it's really based upon the lower price. So I staying away from Allied right now.
And no other REITs either? Just stepping back
completely.
entirely?
I step back from it all. Most of my high net worth investors have their own real estate, and I just prefer to stay away from the public markets on the real estate side of things.
All right. Next email is from Al. With the expected end to the war soon, maybe, higher inflation and a possible increase in interest rates, where do you see the price of gold in the near term?
Great question. In the near term, we've seen gold go from 4,500 to 4,100, and why is this? Well, it's really, to frame it, is really a re-rating of the interest rate impact. Higher rates is not necessarily great for gold. After all, when you buy gold, what is it yielding? It's absolutely nothing. However, structurally, the case for gold remains quite strong. It's central banks continue to buy. It's strong for diversification. And the geopolitical safe haven risk will return. If you look at gold, kind of peaked out right at the time of the Iran war was launched, and it has come off dramatically. But I still think that the fundamental case for gold is quite strong. And instead of buying gold directly, I tend to buy individual stocks. And my number one is Agnico Eagle. I think it's down over 220 or something close to that. And it's a great buying opportunity. So I'm still bullish on gold.
All right, and are you surprised at gold, the drop-off it's seen since the war? I mean, a lot of the time, sometimes it's usually you see gold go up when there's pressure like that.
Yeah, you do. Usually when there's a situation of geopolitical risk, gold goes up. But usually when there's geopolitical risk, interest rates come down. So with interest rates going up, that has impacted gold to come down a little bit. So I am surprised it has come down, closer to 4,100. But I do think it's a buying opportunity. At the end of the day, these miners are producing gold at all-in sustainable cost, about $1,500 US. So if we're getting 4,100 an ounce, still a license to print money.
All right, let's get this last email in from Jim. Is Palantir facing challenging pushback and looking toward more dramatic downward share price pressure?
Great question. It's a stock that tier one infrastructure. It's really dependent on the government. It's not cheap. It's quite volatile. The narrative of AI and the pressures of the AI situation is really coming into play with Palantir. I've avoided it. I prefer companies that are already existing for a long time and have strong track records of cash flow, and they're using that cash flow to build, where this is more of a growth story with Palantir. I prefer existing companies that are growing with AI at the same time.
All right. On that note there, Steve, we'll wrap things up here. Thank you, as always, for joining us. Appreciate it.
Thank you so much. Great to see you.
All right. Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel with Wellington Altus Private Counsel. Thanks again for joining us today. The Open is up next. Trading gets underway about 30 minutes from now. Have yourself a great day.